Imagine a casino open 24/7, 365 days a year, where trillions of dollars change hands every single day. This isn't just a place of chance and luck, but a meticulously orchestrated system where every move is calculated and every decision can have far-reaching consequences. No, this isn't the plot of a new James Bond film. It's a real-world phenomenon that affects us all. It's the foreign exchange market, or Forex for short. Unlike a traditional casino, the stakes here are much higher, and the players are global financial institutions, corporations, and governments. It's the largest and most liquid financial market in the world, dwarfing even the stock market in sheer size. With a daily trading volume exceeding $6 trillion, the Forex market operates on a scale that is almost unimaginable. This market is so vast that it makes the stock market look like a small pond in comparison. The Forex market is a global network of buyers and sellers trading currencies at lightning speed. Every time you buy a product from overseas or exchange currency for a holiday, you're participating in this massive global network. But the impact of the Forex market goes far beyond individual transactions. It's a complex web of financial interactions that influences everything from the price of goods and services to the economic stability of entire nations. You're participating in this massive global network. But the Forex market isn't just about tourists and consumers. It's a critical component of the global economy, affecting businesses, governments, and financial institutions worldwide. But the Forex market isn't just about tourists and consumers. It's the engine room of international trade, allowing businesses to buy and sell goods and services across borders. Without it, the global economy would come to a standstill. It's the engine room of international trade, allowing businesses to buy and sell goods and services across borders. This market ensures that companies can operate smoothly, regardless of where they are located. It's where currencies are bought and sold, their values fluctuating constantly based on supply and demand. These fluctuations can have significant impacts on businesses and economies, influencing everything from profit margins to national economic policies. It's where currencies are bought and sold, their values fluctuating constantly based on supply and demand. Traders and investors closely monitor these changes, making decisions that can lead to substantial gains or losses, their values fluctuating constantly based on supply and demand. Understanding these dynamics is crucial for anyone involved in international trade or finance. Understanding the Forex market might seem daunting, but it's crucial to grasping how the global economy functions. From multinational corporations to small businesses, everyone is affected by the movements in the Forex market. But it's crucial to grasping how the global economy functions. From the price of your morning coffee to the stability of entire nations, the Forex market touches every aspect of our interconnected world. From the price of your morning coffee to the stability of entire nations, the Forex market touches every aspect of our interconnected world. It influences interest rates, inflation, and even political stability. The Forex market touches every aspect of our interconnected world. In the following sections, we'll delve deeper into this fascinating world, exploring the forces that drive it and the impact it has on our everyday lives. In the following sections, we'll delve deeper into this fascinating world, exploring the forces that drive it and the impact it has on our everyday lives. We'll look at the key players, the strategies they use, and the risks they face, exploring the forces that drive it and the impact it has on our everyday lives. So, buckle up and get ready for a crash course in the exhilarating world of Forex. Whether you're a seasoned trader or a curious observer, there's always something new to learn in this ever-evolving market. So, buckle up and get ready for a crash course in the exhilarating world of Forex. This journey will take you through the highs and lows, the risks and rewards, and the intricate mechanisms that make the Forex market the world's biggest casino. Remember when buying something from another country was a rare and exotic event? Those days are long gone. Thanks to globalization, the world is now a global village. We're all connected, buying and selling goods and services across borders with increasing ease. This interconnectedness has revolutionized the way we live, offering us access to a wider variety of products at competitive prices. But this global marketplace wouldn't be possible without the Forex market. It provides the lubrication that keeps the wheels of international trade turning smoothly. Imagine a British company importing coffee beans from Colombia. they need to pay the Colombian farmers in Colombian pesos. This is where the Forex market comes in. The British company can use the market to exchange their British pounds for Colombian pesos, facilitating the transaction. Globalization has fueled the growth of the Forex market, and the Forex market, in turn, enables further globalization. It's a symbiotic relationship that underpins the interconnected world we live in today. Why do countries trade with each other? This question has intrigued economists and policymakers for centuries. The simple answer is that trade allows countries to obtain goods and services they cannot produce efficiently themselves. But there's more to it than just that. Why not just produce everything they need themselves? The reality is that no country is self-sufficient in every aspect. Natural resources, climate, and technological expertise vary greatly across the globe, making it impractical for any single nation to produce everything it needs at the highest quality and lowest cost. The answer lies in a concept called comparative advantage. This principle, first introduced by economist David Ricardo in the early 19th century, explains how trade can benefit all parties involved, even when one country is more efficient at producing all goods compared to another. This economic theory, in its simplest form, suggests that countries should focus on producing and exporting goods and services they can produce more efficiently than other countries. By doing so, they can maximize their economic output and trade for goods that other countries produce more efficiently. They then import goods and services that other countries can produce more efficiently. This exchange allows countries to benefit from each other's strengths, leading to a more efficient allocation of resources globally. Take the example of Japan and Italy. These two countries have distinct areas of expertise that make them ideal trading partners. Japan excels in manufacturing automobiles thanks to its advanced technology and skilled workforce. The country's investment in research and development has led to the production of some of the most reliable and innovative cars in the world. Italy, on the other hand, is renowned for its exquisite leather goods, a testament to its rich tradition of craftsmanship. Italian artisans have honed their skills over generations, creating leather products that are highly sought after for their quality and design. It makes economic sense for Japan to specialize in car manufacturing and export cars to Italy. By focusing on what they do best, Japan can produce cars more efficiently and at a lower cost. Italy can focus on producing leather goods and export them to Japan. This specialization allows Italy to leverage its unique skills and resources, producing leather products that are unmatched in quality. This way, both countries benefit from trade, enjoying a wider variety of high-quality goods at competitive prices. Consumers in Japan can enjoy fine Italian leather products, while Italian consumers can drive high-quality Japanese cars. This principle of comparative advantage, facilitated by the Forex market, drives international trade and shapes the global economic landscape. The foreign exchange market, or Forex, allows countries to trade currencies, making it easier to buy and sell goods and services across borders. This interconnectedness not only boosts economic growth, but also fosters international cooperation and understanding. In the aftermath of World War II, the world was in ruins, its economy shattered. Cities lay in rubble, industries were decimated, and millions of people were left homeless and jobless. The war had not only taken a toll on human lives, but it also wreaked havoc on the global economic structure. Nations were desperate for a solution to rebuild their economies and ensure such devastation would never happen again. Seeking stability and a way to rebuild, world leaders met in Bretton Woods, New Hampshire, in 1944. This historic conference brought together representatives from 44 allied nations. They aimed to create a new international monetary order that would foster economic cooperation and prevent future conflicts. The stakes were high, and the world watched with bated breath as these leaders deliberated on the future of global finance. This meeting gave birth to the Bretton Woods system, a fixed exchange rate system designed to regulate international finance and promote trade. The system established the International Monetary Fund, IMF, and the World Bank, institutions that would play crucial roles in the post-war economic recovery. The Bretton Woods system was seen as a beacon of hope, promising a stable and prosperous future for all. Under this system, currencies were pegged to the US dollar, which was directly convertible to gold. This gold standard provided a solid foundation for international trade as it eliminated the uncertainties of fluctuating exchange rates. The US dollar became the world's primary reserve currency, symbolizing economic stability and trust. This fixed exchange rate system provided much-needed stability, allowing economies to recover and trade to flourish. Countries could now engage in international trade with confidence, knowing that exchange rates would remain stable. The post-war era saw unprecedented economic growth, with industries booming and living standards improving across the globe. However, the Bretton Woods system had its flaws. It was inherently rigid, and as global economic dynamics evolved, the system struggled to adapt. The fixed exchange rates, while providing stability, also limited the flexibility of national economies to respond to changing economic conditions. This rigidity would eventually lead to significant challenges. It relied heavily on the stability of the US dollar. As the anchor currency, the US had to maintain large reserves of gold to back its dollar. This placed immense pressure on the US economy, especially as it faced growing fiscal deficits and inflationary pressures in the 1960s. The sustainability of the Bretton Woods system was increasingly called into question. As the U.S. economy struggled in the late 1960s and early 1970s, the system began to crumble. The U.S. faced a balance of payments crisis, and confidence in the dollar waned. Other countries began to demand gold in exchange for their dollar reserves, further depleting U.S. gold reserves. The situation became untenable, and the world braced for a significant shift in the global economic order. In 1971, President Richard Nixon took the U.S. dollar off the gold standard, effectively ending the Bretton Woods system. This bold move, known as the Nixon shock, marked the end of an era. The decision was driven by the need to address the economic challenges facing the U.S. and to prevent a complete collapse of the international monetary system. The collapse of Bretton Woods ushered in the era of floating exchange rates, where currency values are determined by market forces. This new system allowed for greater flexibility, enabling countries to adjust their exchange rates in response to economic conditions. However, it also introduced a new level of volatility and uncertainty in international finance. This system, while more volatile, is considered more reflective of economic realities. It allows for the natural adjustment of currencies based on supply and demand, providing a more accurate representation of a country's economic health. Despite its challenges, the floating exchange rate system has become the norm in global finance. It remains the dominant system in the world today. The legacy of Bretton Woods lives on, not just in the institutions it created, but in the lessons it taught about the need for international cooperation and the complexities of managing a global economy. As we navigate the ever-changing landscape of global finance, the story of Bretton Woods serves as a reminder of the delicate balance between stability and flexibility.